This week in the economy, manufacturing keeps sputtering while consumer confidence sinks and the Federal Reserve leaves interest rates unchanged amid an uncertain inflation environment. Let's dive in. Before we begin, remember to like this video and subscribe for more economic updates. Perhaps the most notable piece of news this week was that the central bank's Federal Open Market Committee convened for its third policy meeting of the year. Fed policymakers were widely expected to leave the benchmark federal funds rate in place at the target range of 5.25% to 5.5%, and that's just what they did. This marks the sixth consecutive meeting at which Fed officials opted to leave rates unchanged. A potential loosening of monetary policy did come in the form of a vote by committee members to begin slowing the pace of balance sheet reductions. But at the post-meeting press conference, Jerome Powell reiterated that the timeline for actual rate cuts remains unknown. Inflation is still too high, further progress in bringing it down is not assured, and the path forward is uncertain. In other news this week, a stream of jobs numbers included a couple of measures that telegraphed slightly different messages about the labor market strength. On Wednesday, the Labor Department reported that job openings in March fell to their lowest level in 3 years. Openings declined to 8.49 million from an upwardly revised 8.81 million in February. The March figure was decidedly lower than the 8.68 million job openings economists were expecting. It suggests the kind of loosening in the labor market that Fed policymakers may need to see before giving rate cuts serious consideration. Payroll processor ADP reported that jobs in the private sector grew by 192,000 in April, down from the upwardly revised 208,000 jobs added in March, but significantly higher than the 170,000 positions that had been projected by economists. Worries that the economy may not be so resilient after all were underscored this week when the Conference Board reported that its Consumer Confidence Index tumbled last month to its lowest level in more than 1.5 years. On Tuesday, the board revealed that its index fell to 97 in April, a significant decline from the downwardly revised 103.1 posted in March, and well below the 104 projected by economists. It was also the first time since October that the index fell below 100, which signifies more pessimism than optimism overall among consumers. Finally this week, two measures of U.S. manufacturing health, one regional, the other national, pointed to continued sluggishness in the sector. On Monday, the Federal Reserve Bank of Dallas reported that the primary metric of its Texas Manufacturing Outlook survey, the General Business Activity Index, came in at a minus 14.5 in April. That marks 2 straight years the index has landed below zero and in contraction territory. And then on Wednesday, the Institute for Supply Management revealed data suggesting the manufacturing sector nationally is having trouble firing on all cylinders as well. In March, the ISM Purchasing Managers Index made headlines by landing above 50 and in expansion territory for the first time in 17 months. But in April, the index retreated back into contraction territory, dropping past the projected measure of 50.1 and down to 49.2. That's it for now. With all this data, there's one thing for sure. Everything is uncertain. So make sure to check back with us next week to continue getting updates on what's going on with the economy. This is Devlin Steele for Augusta Precious Metals, signing out.